Hello, welcome back. In this class, we're going to be covering covariance and the correlation coefficient. Now, you may be asking yourself, haven't we already covered covariance and correlation coefficient? And the answer is yes. Yes, we have. We did them in the previous reading. Remember the previous reading? What was it called again? Organizing, visualizing, and describing data. That reading that just went on forever, that just wouldn't end. We did see covariance and correlation coefficient over there. So this means that some of what we're going to be doing now in this class we've seen before, but we're also going to be learning a lot of new concepts here. And believe it or not, what we're also going to be covering in this class is variance and standard deviation yet again, but this time we're going to be doing variance and standard deviation for a portfolio. So let's get started then with covariance. So remember covariance, it's a measure of the co-movement between random variables. So for example, we can look at how are two banking stocks moving together, or how are two gold mining stocks moving together. And with population covariance, this is forward looking. I just want to stop there for 1 second, because what we did in the previous reading was this one, the historical covariance. So we are going to be coming to historical covariance in a few minutes, but we're going to start with this one, the population covariance, which is forward-looking. Now, this definition, it's rather hectic, but what we're going to be doing is we'll read it quickly, then we'll break it up into parts, and we'll see it's not so bad. So it's the probability weighted average of the cross products of each random variable's deviation from its own expected value. So let's start at the end of the definition over here. The random variables, these are here, the returns on asset I and the returns on asset J. So what we need to look at now, we need to look at the deviations of these returns, the deviations of these returns from the expected value, and the expected value is here, the expected return. So we can actually link these up together. There's our expected return or expected value. It's the same thing. So what we need to see is we need to see how are the asset returns over here, how are they deviating from the expected value or the expected return? And we need to look at these deviations under different scenarios. Now, E is the probability of a certain scenario happening. And what we need to do is multiply these deviations together. That's why we're talking about here the products of these deviations. And once we've multiplied the deviations together, we also need to multiply by the probability of the scenario happening, which is the E. So we are going to be doing an example on the next slide, which will help to clear this up, because it's actually quite difficult without an example. But once we've done the example, we'll have a better understanding what's going on here. So let's have a quick look then at this information about covariance. Now, the first all of these bullet points over here that I'm running down the screen with, all of these bullet points, I copied and pasted these bullet points from the covariance we did in the previous reading. So this, most of the slide is going to be revision, but it's good to do revision. So covariance, it's positive when the returns on both assets tend to be above or below the expected values at the same time. So this means that when asset I is above its expected value, then so is asset J above its expected value. And when asset I is below its expected value, then asset J is below its expected value. And if this happens, we get an average positive relationship between the returns on the two assets. And again, the example we're going to do on the next slide is going to help to clear this up. And I want to actually come back to this bullet point after we've done the example. So to this we shall return. And then covariance, it's negative when the return on one asset is above its expected value, then the return on the other asset that is below its expected value. So for example, if the return on asset I is above its expected value, when the return on asset J is below its expected value. Then we have negative covariance, and then we got an average inverse relationship between the returns. And covariance, it is 0 if the returns of the assets are unrelated. Now, at this point, I also want to come back to, it's not going to be in the next example, but in a few slides time. So to this one we will return to this one as well. And remember, covariance, it ranges all the way from negative infinity up to positive infinity. So in other words, it's actually difficult to interpret. It does not indicate the strength of the relationship between the two variables. Now, this information here, this is now new for this class. So covariance, it's the same concept as variance, because covariance, of course, it's got the word variance in it. So we would expect that. Hey? So remember, variance, it measures how a random variable moves with itself. So in other words, remember, variance, it measures how volatile is a random variable. But now covariance, like we just mentioned above here, covariance, it measures how one random variable moves with another random variable. And the covariance of an asset with itself is its own variance. And again, I want to come back to this point. It'll be in quite a few minutes time, but to this one we shall also return. And then the covariance values, they are expressed in terms of units squared, just like variance is. Remember, we looked at this in the previous class. Variance is in units squared, like we spoke about in the previous class, also in the previous reading too. So this we know. And we can also see here that we're in units squared because we've got the deviations there multiplied by the deviations there. So that's why we've got units squared. Okay, good. So let's do this example we've been talking about. So now we're doing covariance given a joint probability function. So we've got the returns for two stocks, the stock A and B, under 3 economic scenarios. So they wanted to work out what is the covariance of returns between the two. So this over here is, let's just call this scenario 1. So what this means is that we've got a 20% probability of scenario 1 happening, and we can call this one scenario 2. So this means we've got a 50% probability of scenario 2 happening, and this one we'll call scenario 3. So this means we've got a 30% probability of scenario 3 happening. So let's go straight to work out the expected return on stock A, because then we will understand, how this whole table works. So we need to work out the expected returns on stock A and stock B. Why? Because like we're saying on the previous slide, we need to see how are the stock returns. We need to see how the stock returns deviate from the expected return. So that's why we need to work out the expected return. So to work out the expected return, we are pros at this. It's just a nice, easy weighted average calculation. So let's do it for stock A. So stock A's returns are down here. So we can see there's a 20% chance we got 15%, and there's a 50% chance we got 12%, and there's a 30% chance we're going to get 7% over there. So that's just our weighted average. That's our expected return of stock A. So I put it in red over there. So now for under each scenario, we're going to see how do the returns deviate from that expected return. So then let's do the same for the return on stock B. We've got a 20% chance there of 12%, and we've got a 50% chance of 8%, and we've got a 30% chance of 4%. So I put that in green there. So that's for stock B. So for each scenario, now we can see how do the returns deviate from that expected return. So it looks like, they talk there about 3 economic scenarios. So it looks like scenario 1 is the best economy. So let's say it's the economy is doing well over here. That is because there we've got the highest returns. There we've got the second highest return. So let's call that a good economy, scenario 1. Let's call scenario 2 normal economy, and this is the worst return. So let's call that the poor economy. So now to work out the covariance of the returns between stock A and B, we've got to start with what's the probability of scenario 1? Well, it's 20%. And under scenario 1, what's the return on asset A? 15%. And now we need to see how are we deviating from the expected return under scenario 1? So that we've got to subtract the 11.1%. And then we've got to so this is stock A over here. So let's just put an A over there. And this column over here is for stock B. So then we've got to now compare how did stock B do under scenario 1. So under scenario 1, their stock B is doing 12%, and we can see how it's deviating there from its expected return. So we've done it for the first one, that's scenario 1 over there. Now we need to do this for scenario 2. So for scenario 2, it's got a 50% chance of happening. And then if scenario 2 happens, then the return on A is 12%, and the return on B is 8. And then scenario 3 has got a 30% chance of happening. Let's put it over there. And then we got to, let's see scenario 3. A is, if scenario 3 happens, then A is doing 7 and B is doing 4, and we see how they're deviating from the expected returns. So once we've multiplied all these deviations together and multiplied by the probability of them happening, then we've got to sum up everything, and there we get our answer. Now, I've got a little bit of bad news here. The LOS now says calculate. In the previous reading, when we had covariance, it wasn't explained, but now we actually need to calculate. But I don't think they would ask us to calculate this on the exam because it takes so long. They're more interested in the concepts, you know, on the exam, but still, you never know your luck. So maybe we need to practice a couple of examples, but this is what I am more interested in. What have we got here? We've got a positive number. So what does that mean? Let's just go back as promised to the previous slide. So it says covariance is positive when the return on both assets tend to be above or below the expected values at the same time. Then we get this positive relationship between the two. So let's see, we're going to see now the returns are above or below the expected values at the same time. Let's have a look. So here under scenario 1, asset A is above its mean, and so I mean not its mean, or sort of like the mean. Let's just rather use the correct value. Asset A, I mean, let's rather use the correct words, I should rather say. In scenario 1, asset A is above its expected return, and so is B above its expected return. And the same with scenario 2. In scenario 2, asset A is above the expected return, and so is asset B above the expected return. So in both of those two, both A and B are above the expected returns at the same time. And look at this one over here. In scenario 3, asset A is below its expected return, and so is asset B below its expected return. So in other words, they're both above and below the expected returns at the same time. That's why we got the positive number over here. Good. So now we can carry on, and this is what we did as we saw a few minutes ago. We had a quick squiz at this slide. This is what we did in that previous reading. We did the historical or the sample covariance. Now the difference, it's the average of these deviations. So in other words, that's why we're dividing by the number of periods here at -1. Remember that, where we subtract the 1. So, but again, this numerator is more or less the same as what we had over here. That numerator, it's this bit here. But instead of multiplying now by the probability of a scenario happening, now we don't have the E anymore. We just sum up the deviations this time. And instead of multiplying, we divide by the number of periods less the 1. So it's the average then of the product here of the deviations of the two random variables from their sample mean. So instead of using the word expected value, we now use the word sample mean because it's historical. So before we were looking at the deviation from the expected value. Now our language is how we're deviating from the sample mean. So again, we're going to take all the deviations, sum them up, and just divide there. So let's do the example. It'll clear all this up. So they're asking us, what is the sample covariance of returns for stocks A and B over the following period? So where do we start again? We need to work out the mean this time because we're going to see how are these returns for each year deviating from the mean. So we can just work out the mean, nice and simple over there. So now for the covariance, or the historical covariance, we've got to take each and every year. So this is this year over here. This is going to be 2018. So let's put an 18 in over there. So what happened in 2018? Stock A did 6%, And we can see how it's deviating from the mean of 7. And that's stock A there. This is stock A, and this is stock B over here. And how did stock B deviate from its returns in 2018? Well, it didn't, because stock B, it did 5% in 2018, and its mean is also 5. So there was no deviation for stock B in 2018. But in 2019 over here, we can see how did A deviate from its mean? It did 10, and B did 7. And then in 2020, what's the deal? What happened in 2020? The stock A did 5, and stock B did 3. So how were they deviating from the mean? So this numerator is rather hectic. We sum up all those deviations and we divide by the number of periods there, the 3 less the 1, and there we get 5. So again, unfortunately, the LOS this time is covariance, but I don't expect a calculation on the exam, but you never know your luck. So maybe we just need to practice a couple of examples. Right. So now, we're coming to variances and a deviation. As we said, believe it or not, we're seeing it yet again. Wow. But this time, like we said in the intro to this class, we're doing it for portfolio returns. So now, using our probability model, the portfolio variance of return. So now we've got the variance of the portfolio. And remember, the symbol for variance is sigma squared, like we know. So we've got the variance then there of the portfolio. It's this funny looking formula over here. So we're rather going to look see how it works if we've got a 2-asset portfolio and a 3-asset portfolio. So by portfolio, they mean, more than one asset. So if we've got a 2-asset portfolio, to work out now the sigma squared is the variance of the portfolio, we can almost think of it like a weighted average of the variances, because now we've got 2 assets, we've got asset A and asset B. So we need to take the variance of asset A and multiply that by the weight. How much weight have we got in asset A? So because the variance is squared, so must also the weight be squared. And then we're going to take the variance of asset B and multiply by the weight of asset B. But again, the weight must be squared. And now we can sort of see where this funny formula comes in. So we add 2, and we take the weight of asset B multiplied by the weight of asset B. We multiply that by the covariance between the two. So now, if we've got a 3-asset portfolio, all I want to highlight is the differences, because it's more or less the same, but now we need to take the variance of asset C into account and also its weight into account squared too. And the other thing we need to take into account now is also we're not only looking at the relationship between A and B now, we now also got C. So we need to take the relationship between A and C into account over there, and we need to take the relationship between B and C into account over there. Okay, so we're going to do an example again now, which will help to clear all of this up. So Lebo has a portfolio, and she's got 50% of her money in equity, 40% in bonds, and 10% in property. And this is now what we call a covariance matrix of the 3 assets. And we're going to understand how this matrix works as we work through the example. And just before we get going, this is one of the things that we saw on the first slide of this class. The covariance of a random variable with itself is its own variance. So where equity and equity meets up in our matrix, this is now going to be the variance of equity. So the variance of equity there is 380. So where do bonds and bonds meet up there? 150. So this means that the variance of bonds is 150. And where does property and property meet up over there? So the variance of property is 220. So these are the diagonal terms, these ones here. These are the variances of the different assets, the variance of equity, the variance of bonds, and the variance of property. Right. So now, if we want to work out the variance of the portfolio, they have copied and pasted the formula from the previous slide. We're going to do the 3-asset portfolio. So it's hectic. They won't ask us on the exam to do more than 3 if they're going to ask it at all. I don't expect them to ask us to calculate, even though the LOS does say calculate. I think they're more interested in conceptual things, but still, we're doing, they won't ask more than 3 if they're going to ask. And maybe this one, we would beg your pardon, where would we 2? Maybe that one would be more friendly, but we're going to do the difficult one. Okay, so there's the formula. So what we're going to do now is plug in the numbers. So we're going to take, let's call, so equity is going to be our asset A. So I'm going to put an A over there. Bonds is going to be our asset B. I'm going to put a B over there. And property is going to be our asset C. So I'm going to put a C there for property. So we've got to take the weight we've got in equity squared. So it's going to be 50%, so it's 0.5 squared. We need to multiply that by the variance of equity, which is over there, because it's a covariance matrix. So it's the variance of equity is over there, where equity and equity meets up to 380. And then we're going to take the weight we got in asset B, which is our bonds. So she's got 40% there in bonds. We square that. Then we need to take the variance of the bonds into account over there, the variance of the bonds there, which is 150. And then we need to take the last asset is the property. How much has she got in property? She's got 10%. So we're going to take 10% there squared and multiply that by the variance of the property, the 220. Now we've got to take this term over here. We take 2 times the weight in asset A times the weight in asset B. So it's equity 50% there, bonds 40% there. So it's 0.5 times 0.4. Now what we need to do is take the covariance between A and B. In other words, the covariance between equity and bonds. So we're going to go to our matrix now. Where do we find the covariance between equity and bonds? There, equity and bonds, they meet up over there. 54, or we could do it over there. Equity bonds, same thing, 54 there. So there, that's where we get the 54 from. And now we're going to do the same for A and C, which is between equity and property. So the weight in equity is 50%. The weight in property is 10%. We're going to multiply that by the covariance between equity and property. So where do equity and property meet up over there? 120. Or we could look at what that one over there, 120. So we multiply that by the 120. And then the last one, we got to take B and C, which is bonds and properties. So we're going to take the weight of bonds there, 40%, weight of property there, 10%, and now multiply that by the covariance between bonds and property, which is there. Where do bonds and property meet up over there or there? We could use either one of those two. Good. So the rest we got to know is just getting the calculator out and working it out. So there's the variance of the portfolio. And we know how to do standard deviation. Of course we do. We just take the square root of the variance. So we get 12.58. And remember, standard deviation is in the same units as the underlying data. So there we've got the percent like we know. Good. And this is for me now the most important stuff. The lower the covariances are, because the covariances are over here in the formula, of course, the lower the variance and the standard deviation will be because we're multiplying by them. So there, for example, I've underlined all the covariances over here. So the lower these covariances are, the lower the variance will be, and the lower the standard deviation will be. That means the lower the risk. And that means the better the diversification benefits will be, the lower the covariances are. And negative covariances are the best because they even give us more diversification benefits. So for example, if we had here minus 54 and not positive 54, that would make that a minus sign there, which would bring this down. So the lower, the better, because remember our variance and standard deviation measures risk. So the lower they are, the better. Now, if the returns on the 3 assets, if they were independent, then the covariances would be 0. And this is one of the things we promised we would come back to from the first slide we did. Let's just go back there just to make sure we weren't lying. So there, remember this one that we looked at earlier, that if the covariance is 0, then the returns of the assets are unrelated. That's what we're talking about now over here. So if that's the case, if the returns on them are independent, then the covariances would be 0. That would be good as well, because then all we would have to worry about are the first 3 terms. So we could stop over there. Why? Because if the covariances were negative, I beg your pardon, if the covariances were 0, then we'd have a 0 in over there, and a 0 in over there, and a 0 in over there. So all of these other terms would be 0. We would only have to worry about the first 3 terms. Okay, and that would be 120. The variance would then come to 121 only, and that means the standard deviation would be lower. Also be lower, so it would be 11% versus 12.5%. So again, of course, 0 is lower than our covariances are. So that means with lower covariances, again, we get the lower standard deviations. Right, now, just before we run away from this slide, I wanted to just mention one more thing. I just clear that up there so I can make some space. What we've got over here, I'm going to circle them like this. There are 3 covariances there, which are the same as those 3 covariances over there. Because these, remember the diagonal terms here, they are the variances of the actual assets. So what have we've got? We've got 6 covariances because we've got 3 covariances there and we've got 3 covariances there. But only 3 of the 6 covariances are what they call distinct or unique. So although we've got 9 numbers here in the table, we've only got 3 distinct or unique covariances. Now, there is a shortcut to determine how many distinct or unique covariances are there. And the formula goes like this, and I've written it down. It's in front of me now. I made a note of it before we started. The number of unique or what's the other word? Unique or distinct covariances is this. You take n, which is the number of assets, multiplied by the n again minus 1, and we divide that by 2. So that's the formula. We're going to see it's going to work out now at, it should work out at 3, because we've said we've only got 3 distinct or unique covariances. So n, we've got how many assets here? We've got 3 assets, and 3 minus 1 is 2. So we've got 3 times 2 in the numerator. That's 6 there. Divided by 2 is 3. So we have got 3 distinct or unique covariances, those 3 over there. So I didn't have space to put all of this in on the slide, so I thought let's rather just talk about it when we get here. So it's done. So just make sure you have a look at that, and you will see it in your books as well, this little formula to see how many distinct or unique covariances there are in our matrix. Good. So now we come to correlation coefficient, and this we have seen before. So remember, the correlation of the returns between asset I and asset J, it's got this Greek letter which is called rho. So rho also stands for correlation, the correlation of the returns between asset I and asset J. How do we get it? We take the covariance of the returns between asset I and asset J, and we divide that by the standard deviations of the returns of asset I and asset J. Now, this is a forward-looking correlation because we're dividing the forward-looking covariance over there between the two by the product here of the forward-looking standard deviations. Right, so if we now rearrange the formula, we can see that covariance is equal to our correlation over there. We're just going to bring these up to the other side of the equal sign. Our covariance between the two is equal to the correlation between the two multiplied by the product here of the standard deviations of the returns of the two assets. So let's try the example. So they tell us the covariance of returns between stock A and stock B is 8, and the standard deviation stock A is 2.91, standard deviation stock B is 2.8. What is the correlation returns between them? Nice and easy. All we do is we take the covariance between the two of them there, and we divide it by the product of their standard deviations, and we get 0.98. Right, so we'll see this in a few minutes' time, but you might remember what this means from that previous reading. Remember the correlation, it's got a range. What's the range? It's from -1 to +1. So this is very close to +1. So this means that we've got a very strong relationship here between the two assets. And we'll see that in a few minutes' time. And this I had in the previous class. I just copied and pasted this box again. Remember that the sign of the covariance over here, that determines the sign of the correlation, because this is going to be standard deviation, that's the standard deviation times standard deviation, that'll be positive. So because we're multiplying, so this covariance, that determines the sign of our correlation. Good. And now what we can do, now don't, this looks very hectic, but don't worry, it's not as bad as it looks. What we can do is we can now construct a correlation matrix from our covariance matrix that we had before. So what we remember, how do we work out correlation? For correlation, we need the covariance there between the two assets, and we divide that by the standard deviations. So that's what I worked out over here. Because we need the standard deviations in the denominator, I've worked out what's the standard deviation of equity and of all of our assets. So let's just go back to our covariance matrix, because what is standard deviation? It's the square root of the variance. So here, remember, the variance of equity is 380. The variance of bonds is 150, and the variance of property is 220. So if we take the square root of all of them, then we can work out, what's the standard deviation of equity? What's the standard deviation of bonds? What's the standard deviation of property? So I didn't work out the correlation of all of them, of all of these numbers in our matrix, but I've just done one, and you guys can just do the rest for homework. So let's say we want to work out what's the correlation between equity and bonds. What do we need? We need the covariance between equity and bonds. Let's just go back there. There's the covariance between equity and bonds there, 54, or we could look at this one, equity bonds there, 54, and we divide that by the product of the standard deviation. So the standard deviation equity is 19.49, and the standard deviation of bonds is 12.24. So there is the correlation between equity and bonds, and that is put in over there. So you guys must just check these two. So these three over here, let's just circle them again. These three over there are the same as those three over there. So we got the three distinct correlations there. And then over here, these ones, the correlation of asset returns with themselves is 1. These diagonal terms here, these are the correlations of the asset returns with themselves: equity, equity, bonds, bonds, property, property. Right. So now, like we saw on the previous slide, that the covariance is equal to the correlation between the two multiplied by the product of the standard deviations. In the variance of portfolio returns formula, we can use that there instead of using covariance. So this over here, this line I'm drawing the pen through here, that is what we saw when we did this example over there. That's the same formula. But now what I've done in the next line is, instead of having the covariance between A and B, I've substituted that with that, because the covariance is the same thing as the correlation multiplied by the product of the standard deviations. And then for this one, instead of having covariance between A and C, we've got the correlation between A and C multiplied by the standard deviations. And then lastly, instead of having the covariance between B and C, we've got the correlation between them multiplied by the standard deviations. So I'm not going to go through this whole thing, and I very much doubt they're going to ask us this on the exam, because it will take all day, but we just need to be aware that it is the same thing. So let's just do one of them that's new. So it's the third term. Hey, so we take the correlation now over here, the correlation between A and B over there, 0.2267 there, and we multiply that by the standard deviation of A there and the standard deviation of B there. Okay, so you guys can just have a look on your own, and you'll see that you just got to plug in all of the numbers. And I was so relieved when this answer came out the same as this one, because it's the same formula really, just doing a different manner. So it had to be that the answers were the same. And I can't tell you the relief when it came out the same, because this took me, you can imagine, it took quite a long time to do this slide. But anyway, it all worked out. So I was very happy with this one. Okay, so let us then, we've got one more slide to do, And this one we've seen before. This is going to be a nice, easy way to end off. So remember the correlation. This now measures the strength of the relationship and of the co-movement, the linear association between our two variables. And as we've mentioned before, remember, correlation has got a range from -1 to +1. Remember, covariance, it's got no range. Covariance goes from -infinity to +infinity. And now we've got the range here. So if it's -1, what does it mean? We've got perfect negative or inverse correlation. So this means if the one asset goes up 5, the other one will go down 5. And then if the one goes down 5, the other one goes up 5. And then if it's +1, then we've got perfect positive or direct correlation. So this means if the one goes up 5, the other one goes up 5. If the one goes down 5, the other one goes down 5. Right. That is perfect positive correlation. And it's going to be 0. If correlation is 0, then we've got no linear relationship between the variables like we've seen before in other classes. And if this is what we did in our example, this one over here, our correlation there was 0.98. So if the two variables have a very strong linear relation, then the absolute value of their correlation will be close to 1, like we had 0.98. So if it's 0.98 positive, then it's very close to 1. So we've got a strong positive relationship. But now, absolute just means what? It means if there's a negative number, just ignore it. So if it's negative, what we need to do is just ignore it because it's still, so we ignore the minus sign. So now we're close to 1. But the only thing we need to remember, what does the minus sign mean? All it means is that we now got a negative correlation, not positive. Right. And then if the two variables have a weak linear relation, then the value of their correlation, that's going to be close to 0, like we know. And lastly, correlation has got no units. It's just between -1 and +1. So why has it got no units? If we just go back to our formula for correlation for 1 second, we've already mentioned, I think it was in the first slide we did of this class, that covariance, remember, it's expressed in, let's say we're using percentages for our situation. It's expressed in units squared. So if we're using percentages, it's going to be in percentage squared. And standard deviation, that is in the same units as the underlying data. So we've got percent there for that standard deviation, and we've got percent there for that standard deviation. So this means we've got percent squared and we've got percent squared, because these two percentages will cancel those two. So everything's going to cancel out. So we're going to have no units for correlation. Excellent. That's it. We are done with that class. I hope it was helpful. So we just need to, practice our examples. Like we always say, practice lots of questions, and let me know if you need any help with anything or got any questions. And then we'll see you guys in the next class. Hello, it's Tim here again. I hope you enjoyed the class and found it beneficial. We have some classes available for free on YouTube, but we have classes for the entire curriculum. The classes that are not on YouTube can be purchased from us. If you'd like to purchase the classes, please contact us for the pricing, and I've put our contact details over here. You can purchase all the classes or certain readings that you would like. When you purchase the classes, we provide you with the slides and our notes. I've assisted hundreds of candidates pass CFA exams, and I look forward to also helping you through the CFA program. I've put in 2 testimonials in the slide over here, and we also have a testimonials page on our website that you can review. I look forward to seeing you soon, and all the best.